Do you know everything there is to the stock market?
How much do you know about it?
The stock market can be a scary thing whether you feel confident in investing in it or not. The stock market cannot be timed and will not cater to anyone. However, there are a few things you need to know about it before you consider investing a large portion of your money in it. With that being said, in this video, we will discuss 5 things you must know about the stock market. Number 1. Big money owns a very large percentage of the stock market. Who do you think of when I say big money? Big money is not just millionaires that have their entire portfolio invested in the stock market. Rather, big money are huge funds that invest a pool of money into the stock market. They are worth hundreds of millions of dollars up to hundreds of billions of dollars. Of course, with large amounts of money at hand, these funds prop up a very large portion of the stock market. Their investment portfolios are usually not invested in just one sector such as technology or energy. With the amount of money they have, they are diversified enough so that the pool of money that they must manage is hedged accordingly. This means that they own many shares of individual companies as well as many ETF shares. If they decide to dump all their shares within a specific time frame, it can easily change the tide of a company stock from being bullish to becoming bearish. This is why it is important to know what you are up against if you decide to invest against large firms. It should be noted that these firms must release their holdings in the SEC Form 13F filings, which can be found online. With everything said, it should be clear by now that the stock market is easily swayed and can move in the direction of the big money. Number 2. Stocks can become very volatile. Although volatility is not something that commonly occurs in the stock market, it does not mean that it is impossible. Take for example, Tesla, Volkswagen many years ago, GameStop, Bed Bath & Beyond, and AMC Theaters. Of course, there are and has been many other stocks that had high volatility, but the names listed are recent and popular examples. It should be noted that the reason for their high volatility is not quite certain, as there are many factors that come into play for each company stock, and it should be up to you to consider whether it is worth investing in. Volatility is a double-edged sword. This is because, with volatility, it is easy to make money, but also to lose money. So if you ever consider buying into a volatile stock, you must have strong conviction to the company stock that you purchase. And you must do the proper amount of due diligence before diving into it. The strongest and most prevalent reason as to why people invest in very high and volatile stocks is because of its potential for a short squeeze. A short squeeze is essentially a very rapid increase in a price of a certain stock, primarily due to the excessive short selling of a company stock. Short selling a company stock is to borrow shares and sell it immediately to the open market. Assuming that the stock will fall in value, the short seller will purchase the borrowed stock at a lower price to return. However, due to the nature of short selling, the price of the underlying stock will most likely fall. Number 3. Stock market crashes are very heavy and largely unpredictable. Since the inception of the stock market, there has been a handful of stock market crashes. A stock market crash is what it sounds like. It is basically a large and rapid decrease in stock prices that end up being catastrophic to investors and firms. There are a few reasons as to what can cause a stock market crash, but it will not be discussed in this video. The takeaway is that stock market crashes comes like a tidal wave. It is quiet and unexpected. Famous crashes that happened in the past include the Great Depression in 1929, Black Monday in 1987, dot-com's bubble burst in 2001, 2008's financial crisis, and most recently, 2020's pandemic crash. If you believe that there will be a crash, it will most likely not happen anytime soon. As the popular saying goes, the stock market can remain irrational longer than you can remain solvent. For those that don't understand, the economist, John Maynard Keynes, means to say that the stock market can keep running against all odds. Hence being irrational to things that affect it, much longer than you can keep calm, collected, and solvent. Number 4. You cannot time the stock market. This point is constantly forgotten by many investors. Many people hold out on purchasing stock or shares because they think the price of the stock is overvalued. They end up holding out on it for many days, which then turn to weeks and months. The next thing they know is that the stock has gone up well over 50% since first discovering it. In the same sense, many people hold out on investing in stocks because they think there will be a market crash or correction. For those who are in this predicament, I present to you 2 quotes which are timeless. The first one is "Time and the market beats timing the market," which was said by Ken Fisher. Ken Fisher is a billionaire investment analyst and founder of Fisher Investments, which is an independent money managing firm. He has written countless books on the market and market behavior, and is a very influential investment advisor. Essentially, having your money invested in the market is infinitely better than trying to figure out the perfect time to put your money in. With this being said, he knows what is best and his advice should be considered, regardless of how long you have been investing in the stock market. The second quote: far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves, spoken by Peter Lynch. By trying to time a correction in the stock market, you could have made significant gains by investing in it. Because after all, how will you know a red day in the market is a market crash? Peter Lynch is a very popular and brilliant investor. He has managed many investments and had an average of 29.2% annual returns, beating the S&P 500 index fund, which to say the least, is absolutely incredible. Peter Lynch has also written many books and is considered an influencer in investments and stock market investing. Both quotes tell you to stop trying to time the market and just to invest. This is because when you try timing the market, you are losing the opportunity to make money. In terms of predicting a crash, it is definitely possible to predict that there will be a crash. Take for instance, Michael Burry, who saw the financial crisis over a year before it happened. However, there are many factors that contribute to the stock market, some that are quite evident and others that are more opaque. Moreover, as mentioned before, the stock market can remain irrational longer than you can remain solvent. Number 5. The stock market can be abused. The stock market is a system that enables individuals and entities to invest their money for assets. However, this also means that the stock market can be exploited and abused. Whether it be the exploitation of human behavior that allows individuals and investment firms to take advantage of the markets with technical indicators, or hedge funds that manipulate price points with their surplus cash, the stock market is vulnerable. If you take a step back and learn about technical indicators and technical analysis, then you will know there are day traders and swing traders that take advantage of other people's ignorance in the stock market, such as letting their emotions take over their trades. Moreover, the prominent use of over-leveraging can be a legal means of abusing the stock market. You don't have to look far to know that the hedge fund Arch-Egos crashed and heavily affected the stock market because of its over-leveraging that it had exploited for many years. In fact, if there was no 2020 outbreak, Arch-Egos could have continued over-leveraging indefinitely. Sure, you can argue it is smart to over-leverage your assets, but the fact that it can be over-leveraged hundreds of times over means that they can hold a significant portion of the stock market. Therefore, when a crash or correction happens and the hedge fund or firm inevitably tumbles, then not only are they in a terrible position, but so are the regular, everyday investors. This video has been 5 things that you must know about the stock market. Whether you are a beginner or an experienced trader, certain things about the stock market should not be ignored. With everything said and done, let us know what you think about these 5 points in the comments section below, and remember to like this video and subscribe for more content like this.